All right, so Andrew Holland is here with us to talk about more on markets. Andrew, good afternoon. Thank you very much for your time. How are you analyzing this furious rally which is playing out in the market in the face of so much of criticism, naysayers shouting from rooftops that fundamentals and market prices are not converging, they will, and things are really bad, and they indeed are if you look at in isolation things on ground, but markets is just refusing to look at any of that.
No, you're right, Ajay. It's fundamentals are just kind of thrown away at the moment, and liquidity rules the wave. So, we're all wearing rose-tinted glasses. We're all saying that that we're going to get through this quarter, go into next year, middle of 2021, and you'll start to see the full kind of recovery in terms of GDP growth rather than negative growth. So that's what the market's baking in. And, each time, if you take last month when we had what could have looked like a kind of smart kind of, downfall in the markets, the Fed steps in and says, no, we're going to start buying corporate bonds, and everything gets reversed. And then everyone goes back to, yes, the Fed does have my back. So that, so all of this just, leads to any fundamentals. Any news is good news. It doesn't matter what it is at the moment, because anything negative, the government's going to do more spending, or the Federal Reserve or central banks globally will throw more money at it. And that's where we are. So markets are just enjoying this. But I think we spoke about this before, Ajay, is that, something at some point will prick that liquidity bubble. Not sure what it will be, but once it is, then all the negatives or fundamentals that we talk about will be, kind of wheeled out as the excuses for the market's fall. So you just have to wait sometimes for that event to happen, whatever it might be.
Right. How are you guys approaching markets right now? What's your analysis? You are a conservative lot, isn't it? Are you sitting on the side observing, or you are, participating in it on a selective basis?
No, we are participating on a selective basis. We're taking the view for the fund that, it's more of a trading market because, because fundamentals, you just said at the beginning, don't seem to be playing out. Therefore, we're not taking any kind of real negative or positive view towards where we think direction will be, but more trading it, because that we feel was a strategy which worked back in 2008, 2009. And will continue to work here. I think, a few of the things that kind of just concern in the short term is that, the VIX, both here and in the US, is still, way above 20, nearer to 30, which, means that volatility will remain high. And two, the increased number of cases coming out in the US is worrisome, although markets are just ignoring that for the time being. I suppose the third factor, which I think is important, is if you look at the recent mobility figures, across the US and Europe, including the UK, then you've seen a flattening off in terms of people's movement to kind of retail recreation. So that either confirms one thing, that either that initial splurge of spending people have had once lockdown has been reopened. Is kind of not quite finished, but is probably the most of it's done. Or two, consumers are now becoming wary of the social distancing problems, which obviously opening up of the economy would have for them, and therefore being a bit more cautious on what they do and how they do it. So those are the kind of things that will play out in the next few weeks. But those are the things that I would kind of worry me. And I haven't talked about all the other things that worry me, but those are two of the things that worry me.
Andrew, let's talk about the banking space. There's so much happening almost every day. There is some amount of news coming in. Yesterday, I broke that exclusive news of the $1.5 to $2 billion share sale plan which Axis Bank is going ahead with. And I am gathering that there's very good appetite from private equity guys like Carlyle. Bain is keen to increase stake, though they've just given it out on the exchanges today that they are indeed looking at share sale. The shape and the response will develop over the next few days, but some other big players have also managed to do it. quite successfully. How would you read that big fundraisers by top banks? Would you be a pessimist saying that probably great provisioning cycle lies ahead and they are shoring up their balance sheet, or would you say that they are being prepared to ride this COVID storm and you would look at these top large cap banks favorably? Which side of the argument are you?
I think it's a little bit of a mix, actually, because from what you're saying is I kind of agree that the shoring up the balance sheet because they're seeing something that kind of concerns them. If you think about the amount of liquidity that's kind of rolling around in India, if you speak to most of these banks, and we have spoken to the Access Management, and they're saying that they're looking at doing loans or working capital loans to companies that they know and they've been dealing with for some time. So they're not really stepping out and adding risk. So they're either thinking that there's in the short term, there's a bigger problem that they're seeing because we are kicking that can down the road a little bit by the liquidity measures that the RBI has brought in over the past few months. So I think that they're doing two things: one, shoring up the balance sheet for maybe some bad times ahead, but also taking the opportunity to raise capital for possible acquisitions going forward or inorganic growth, which they can take advantage of. But for sure, all of these banks would need to have the kind of capital to, from a longer term perspective anyway, for the long term growth of India, would need to have that be better capitalized than they have been.
Right. How are you looking at the entire NBFC space? They have also been beneficiary of a lot of steps taken by RBI recently. In fact, just last evening as well, a special liquidity window for mid to small NBFCs, HFCs included, has been provided, and a host of other measures. Have liquidity situation indeed improved for NBFCs in your view? Over and above that, some transactions also being attempted at. M&M Finance is going for a rights, Shriram Transport. Edelweiss, I gather from my sources today, is going through a transaction in their wealth arm. All of these measures are actually indeed to improve liquidity on their books, and they went through a rough patch right now. What are your thoughts on mid to large cap NBFC space?
So I think again, it's a matter of picking the best out of that, and I think. For a lot of these companies, it is just a balance sheet problem and a mismatch of liabilities. So they need to kind of offset that by either doing deep discounted rights issues or selling off part of their jewelry or best assets. So that's the if I think about it, that's the nature of the problem for them, and it's going to take them quite a while just to get through this. And even when things do improve and the economy starts recovering, I think I think they still don't have the kind of balance sheets to kind of propel them and take market share going forward. So it's only those those larger ones like the Bajajes, who have really just have and can clean up in this, and maybe you can put Piramal in that as well, having done that recent share issue as well to shore up their balance sheet. So there's only going to be a few big survivors from here. I think the other ones will survive, but a very limited kind of business model going forward, because obviously they're still sitting a lot of problems which are just not going to go away in the next 6 months.
Right. Which is the most attractive space looking to you right now in terms of valuation, risk reward, everything put together?
I'll tell you what we've done, Ajay, rather than kind of pick out one sector or another. Is the approach we've taken to the market is really like a barbell approach, where we have obviously the defensive sectors like FMCG, telecom, pharma, and then on the other side of that barbell is going to be those sectors which would benefit from the recovery. So financials would be in there for sure, and then you've got industrials, energy, and consumer discretionary, mainly autos, which again would benefit from an upturn in the economy once we see that. So that's the approach we've taken. if I had to kind of pick one sector which kind of, kind of gives me a lot more confidence going forward than for many, many years, is the pharma industry. For two reasons, extra reasons. One is that for the first time in years, I can think that the generic companies actually have some pricing power going forward. So that's the good news. But the big news for me would be that, as and when any vaccine comes through, I am absolutely certain that, some of the pharma companies in India will be a beneficiary of manufacturing some of those vaccines. So they've got some great tailwinds ahead of them going forward. So even though valuations, people say, they've had a good run, I think this is could well be the onset of a new kind of profit curve for them, which we haven't seen, from those early days of generics. So this could be a big re-rating story over a period of time.
Right. How much of the risks are you watching out for, or what exactly could be the risk to this kind of momentum rally which we are looking at right now? Because there are some negative in this rally as well, like the penny stocks which have started moving up. One indicator is the amount of record numbers from retail traders and investors which are joining the market. What could prick the balloon in your view? Could it be global or could it be local?
I think it's going to be, Ajay, it's going to be global, because, we're slavishly just following, global markets. I don't think there's any fundamental reason that, we differ. And you're right, it's been a lot of retail participation in India, but also globally, which is, is unusual, given the volatility that you are seeing in markets. But that's, that's what's been happening. What could prick the bubble? It could be many things. I think, the other day I thought it might be, the facts of Unilever and Coca-Cola saying, we're not going to advertise on social media. Was that going to prick the bubble of a lot of those FANG stocks? Doesn't seem to have done so. Could it be the US-China trade deal? Could it be, India-China, which has an impact here in India, because obviously we have a trade deficit with China, and we are dependent across a number of sectors, for raw materials. So that could be another part of it. It could as well be that the opening of Europe in terms of their borders, they're kind of moved by the UK in distancing rules from 2 meters to 1 meter. They'll have a new wave of viruses and then lockdowns again, which could just kind of scupper things in the short term. So those are the kind of things which could prick the bubble, but you have to wait and see what those are, because nothing at the moment is affecting it. But those are the things that will wheel out, and I'll tell you is the reasons why markets are falling, I'm sure.
Right. All right, Andrew, always great having you on the show. Thanks very much for joining in today as well. We'll let you go on that one. That was Andrew Holland, someone who's really seen the cycles a lot, has a measured view on the market, doesn't really get excited so easily because of the shades which is seen in the market.